In this week's episode of the Stockscores Market Minutes, I'm going to talk about how much money you need to day trade. Plus, I will do my normal weekly market analysis. We'll look at the day trade of the week and run a market scan in search of opportunity. So how much money do you need to day trade? Well, a few things I want to emphasize first. Because there's no barrier to entry into trading the stock market, or very little, it's very easy for someone to blow themselves up in the market without knowing what they are doing. You know, you can come in, open an account, put some cash in it, maybe read a book about trading, and quickly lose your capital simply because you haven't developed the skill yet. So the first thing I want to emphasize is that every new trader should start out trading with no money, just practice, paper trading, learning your skill, and take courses, read books, learn how to do it, learn from others who know what they're doing, but do not start trading with real capital. Now, once you've gathered some experience and you've been paper trading for a while, once you get to having some consistency in your paper trading, then start trading with real money but very little risk. So maybe risking $50 a trade or something like that. There is this emotional attachment to money that will add an added dimension of difficulty to trading. You know, paper trading is great, but when there's no money on the line, there's no emotion. And emotion causes us to make mistakes. So start with a small amount of risk, say $50 a trade. If you can earn $500 at that sort of risk level, then increase your risk to $100 a trade. Now, each week we do the day trade of the week, and I always talk about the risk amount on the trade, and I use $100 just as a good base level. That $100 risk amount is the difference between where you buy it and where you take your loss, where the stop loss order would be, or some multiple of that. And so when you're trading, when I say $100 of risk, that doesn't mean you're buying $100 worth of the stock. It means that's how much you're risking if you are wrong. All right, so you make $50 a trade in risk and you make $500, then you increase it to $100 of risk per trade, make $1,000. Now you can increase your risk to maybe $200. As long as you are comfortable with the risk you are taking, then it's okay. The moment that the financial risk becomes burdensome, then you need to scale it back, because the emotions that come from not being comfortable with what you're risking is going to cause you to make mistakes. So how much money do you need? This is the key question. Well, if you're risking $50 a trade, you probably need about $5,000 in capital. As a general rule, I take the risk tolerance amount and multiply it by 100. That will allow you to hold more than one position, maybe 2 or 3 at a time, and that diversifies your risk a little bit over multiple trades. If you're risking $100 a trade, then you're going to need about $10,000 of capital. Now you can do it with less, but it gets more difficult because you have to focus on lower price stocks, lower market cap, and they tend to be less liquid, and also there's just fewer stocks to choose from. You can do it, certainly, but realize that you're putting some things against you when you have that much less capital to trade with. So there it is. Take your risk amount, start slow, $50 a trade, maybe even $25 a trade. Also remember to factor in commissions, because some brokers will charge you a flat commission per trade. And if you're trading at a very low risk level, that flat commission can make up a big portion of the actual risk. And so you don't want to have a broker that charges you that flat rate if you have small position sizes. It's better to trade with a broker that charges you a very small amount per share, so that you've got a good way to manage your slippage and your commissions relative to risk. Okay, well, I hope that's been useful, and let's get on to this week's market analysis. And as always, we start off with the S&P 500. This is the 60-minute chart. You can see the little break that we had this week and continue to be in that good upward trend. You got to wonder when this upward trend is going to end. I mean, it's been intact for a long time, but we're not particularly overbought in the sense that there's no parabolic trend. We were a little bit parabolic coming into Friday morning, and we've retraced that. So still okay. When we look at the 3-year weekly, Again, you just see that that trend is well underway. And, the question is, how long can it continue? There's no sign of weakness, no sign of a breakdown, so you just ride the trend. Looking at the NASDAQ 100, this is getting a little overextended short term. This is a daily chart, and you can see that if we draw a line across the tops, we're kind of at that. So it wouldn't surprise me at all if we see a little pullback there in the short term. What I like the most this week is the Russell 2000 chart, and we've talked about this for a long time. It has really lagged the large cap sector. We're breaking from an ascending triangle, good volume, good price action, breaking out. I think we're going to see a rotation into these small cap stocks as retail investors start to buy those cheaper stocks, which they favor. This should start a nice upward trend. Think back to last year, we had such a great market for trading those small cap stocks, and it all started with breakouts and then a nice upward trend. Well, perhaps we are starting another one of those, and I think that is the place to focus right now. Canadian markets, TSX managed to break out of its little trading range this past week and is in a bullish trend in the short term. Also in the long term, nice long-term upward trend there, so remain on the buy side, although I think you don't want to chase stocks. If a stock's gone up a lot, then it's getting risky. TSX Venture has also managed to start to come alive again, broken that downward trend a few weeks ago, and now slowly building that upward momentum again. It will find some resistance here, which is where it's at right now, and then here, but generally speaking, looks better as we are in stock trading season. Currencies, US dollar still building optimism slowly. When I say optimism, what I mean is rising bottoms on the chart. That means the buyers are in control of the US dollar, but not with a lot of excitement. It needs to, break out of this little trading range it's been in. On the Bitcoin side, it's had a couple of weeks of sort of pausing after 3 strong weeks to the upside and, essentially getting stuck at some resistance. Remember, this is an ETF, so the actual Bitcoin chart actually is reaching to new highs. This one is lagging a little bit. We look at Ethereum, I've been more, bullish on Ethereum than I have been on Bitcoin, and that was because it was building rising bottoms and now breaking through that resistance. So I think if you are long of that, it looks pretty good, although initiating a position now may be getting a little bit risky. On the commodity side, gold had a good run on Friday, and it's looks pretty good on the daily chart. On the weekly chart, it has not yet broken this downward trend line, but it is starting to build some optimism. And so I think something to watch. I wouldn't get too excited just yet, but it's looking a little bit better. On the oil side, we've had a couple of weeks of profit taking, but very reasonable in the context of the recent gains. And I think we could see a little bit more of that, but I wouldn't be too worried about, a major sell-off because support is still intact. The upward trend is still intact, and therefore I think it's still a place to be long of stocks, although some of them may see some short-term profit taking. On to the fear chart. Of course, the VXX is the volatility index, and it took a little bit of a jump higher, but really in the context of that trend, it's nothing. So fear is still relatively low. So my ratings then, bullish on both time frames for US and Canadian stocks, neutral long-term on gold, but I've raised it to bullish short-term because there was some life in gold at the end of last week. Oil bullish long-term and neutral short-term as it works through a little bit of profit taking. Well, stocks and the indexes are in upward trends, with the large cap getting a little overextended, while the small caps seem to be just starting a new upward trend. They're breaking out of that lengthy sideways trading range, and that's a good sign if you like to trade those lower price stocks. Gold starting to show some life, but there's still the need to break that downward trend line. Oil, as I said, has been seeing some short-term profit taking, but still in a long-term upward trend. All right, let's take a look at the day trade of the week. Every week I try to show an example of a stock that met one of our day trading strategies, and this particular stock on Friday met the requirements of the day trader strategy, the Stockscores day trader strategy, which utilizes action candles, my own indicator, and what we look for is an action candle breaking out of a predictive pattern. This pattern here is called an ascending triangle, broke out of that. It also met the requirements of our pullback play or even our superhero strategy. Not quite as ideal for those because the volume wasn't real strong yet, but you can see it went on a nice parabolic move. What the real lesson that I want to emphasize here is that when stocks go into parabolic upward trends like this one, so you can see here linear and then it gets steeper and it really starts to get parabolic, we look for something called a bursting bubble candle. And a bursting bubble candle occurs when you have a parabolic trend and you have a candle that hits a new high, closes below its open, which is why it's red, and has strong volume. All right, so it's like the blow off, the emotional blow off after a steep upward trend. And that is a very good reason to sell. So we're buying here, we're selling here. And in this case, the economics work out really well on that trade. For every $100 of risk, you would buy 450 shares back here. That required $2,282 of capital, but you should be able to leverage that trade 3-to-1 if you are day trading. So really you only have to put up $760 of capital for every $100 of risk. And at the sell signal here, that was up 11 times risk, which meant for every $760 of capital, you had an $1,100 gain. That's 144% return. Obviously a great trade for a relatively short-term hold. The key to finding these is being able to find action candles, and we do that with our active live service every day. And of course, having the patience to let the trade run, being fussy enough to take this trade, but not some of the garbage signals that we get. And all of those things are essential to doing well as a day trader. All right, let's go into the Stockscores market scan and just see if we can find some longer term trades. And what I'd like to run today is the Abnormal Breaks US scan. I do this scan every day, typically in the final hour, although you can run it in the after the market closes as well. Obviously, if you run it after the market closes, you have to take your entry the next day, and that's essentially what we're doing now. Now, I've limited my search today to just the stocks under $20, and we still have 89, and that's a sign of how much action there was in the market on Friday. The action was pretty good. So what we're looking for here now is predictive chart patterns. So this pattern here on AVGR is a break of a downward trend line from a slightly rising bottom. So that's good. Volume is there, but it's not super. You really need a lot more volume to work through all of this overhead resistance. So I would give that a 6 out of 10, which means I think it has a 60% chance of working. Now, the process that I'm going through right now is what we cover in the investor course on Stockscores. And of course, access to the Stockscores tools is what allows you to do this market scan. So I really like this chart, ASRT. It's got really good abnormal price action, abnormal volume, breaking from a rising bottom, breaking through resistance. This is a strategy I have called a bottom fishing strategy. And it's essentially looking for a reversal of stocks that have been weak of late. And so we're going to see a lot of these days because a lot of these small cap stocks are in these downward trends and they're starting to turn around. I would give this a 6.5 out of 10. I'm very tempted to give it a 7 out of 10. And what stops me is that we may see the stock stall up in here from some resistance. What I like, though, is that the volume is so strong that it may have that ability to chew through this. So 6.5 to 7 out of 10, meaning I think it's got a 65 to 70% chance of moving higher. And so this is the process. I do this every day, just scanning through stocks, looking for those that are breaking from predictive patterns. Many of the patterns on these cheaper stocks are similar in that they are breaking up into pessimism. And so they need the volume to be able to overcome that pessimism. Now, the good thing is that these stocks have the optimism that's coming from a favorable IWM chart. That Russell 2000 small cap index chart is also looking good, and that means sentiment is turning for these lower price stocks. All right, DMAC, also a good pattern here. This is an ascending triangle, so I'm not drawing this perfectly, but you get the idea. See a little breakout there with some volume. Wish the volume was a little stronger, but the good thing about this one is it's not really going to encounter resistance up until about here. So it has lots of upside potential before it gets there. So I would give this a 6.5 out of 10 as well. So we'll go through a couple more charts, see if there's anything else to mention here. I won't go through all 89 of them because that takes a little bit too long. However, I do run this process, and these videos are created every day in the last part of the day, in the last hour. And you can subscribe to that at tradescores.com, where I do a daily market scan video and just try to make some picks. I think the performance in the last year is about 55% return on those picks, so something to consider. Tradescores.com, which is my other website. All right, this will be our last stock to consider here. There you see the downward trend and a little build of a rising bottom and trying to break through. Not a lot of enthusiasm. Volume is light, but it's getting better. So I would give this a 6 out of 10. Well, I hope that you've enjoyed this week's Stockscores Market Minutes. And if so, please click on that like button, subscribe, and most importantly, trade well.